The greatest fear of most retirees is running out of money before they run out of retirement. If you've experienced this fear, you'll be interested in my comments about why this is sometimes a self-fulfilling prophecy. Hello, I'm Dr. Shelby Smith of the Retirement Pros, and my objective is to help you have a better retirement. You know, it costs nothing to listen, and I'm confident you'll learn some things of value. So listen up. So why do retirees fear running out of money? Can they do things differently to lessen the chances? During your working years, and possibly you're still working, you probably participated in your employer's retirement plan and/or you had a systematic savings plan that you added to faithfully. If you participated in an employer-sponsored retirement plan like a 401k or 403b, you would have put part of every paycheck into the plan where it would grow tax-deferred. Hopefully your employer also made matching contributions to your account, and also, hopefully, your money enjoyed good growth. Of course, neither of these are certain because employers are not obligated to make matching contributions, and we all know that money invested in the market, mutual funds, variable annuities, stocks of your employer, and whatnot, may not have grown as you would have liked. Regardless, someone else was managing your money, and that's the point I want to make. Yes, you may have been making the selections inside the plan, but the active money management was done by someone else. And frankly, most employees participating in their employer's retirement plan generally make their investment selections based on the recommendations of a coworker, a spouse, or friend that supposedly is more knowledgeable about such things. You may now know that they didn't know as much as you thought they would. Your employer generally does not give advice when it comes to investments. So what happened on the day you retired or maybe shortly following your retirement? Well, the typical situation is that you were given a large check which went into an IRA or other account, and you assume responsibility for the management of your retirement money. Let me ask you, did you have the knowledge, experience, and know-how to manage large amounts of money? If so, you're not the average retiree. Your specialty was probably something else: teaching, engineering, sales, retail, legal, medical, or another profession that did not involve the management of money. Managing money without expertise is no different than trying to do what you did for a living without training, experience, and expertise. Money management is complicated, constantly changing, involves numerous options, and requires years of study to be good at it. Eventually, most retirees discover they need help with their money management and seek professional help. But far too many are distrustful, think they can do it better, and the results are generally not so good. So the first reason many retirees outlive their money is because they attempt to manage their retirement money without professional help. I sincerely hope you're not one of them. Maybe you chose to work with a broker that works for a Wall Street firm. Stockbrokers generally recommend stocks, bonds, mutual funds, variable annuities, REITs, limited partnerships, options, diversified portfolio, or other investments of the moment. The one thing that all these have in common is market risk. The market goes up and down with economic and financial cycles, and so does the value of the investments you have in the market. So before you speculate on which way the market is likely to go, you need to ask yourself, what happens to me and my loved ones if I lose some or a big part of my retirement money? Possibly you were told that in the long run you'd be just fine. And maybe that's true, but no one knows what will happen in the future. The two major market meltdowns since the year 2000 prove that there is risk. If you take risk, you have the probability of making a higher rate of return, but it is not guaranteed. Market risk is generally suitable if you have more money than will be needed for retirement. But if all your money will be needed for retirement, you should be extremely careful about the risk you take. The best way to make sure your risk is suitable is to work with a financial planner. Carefully consider their recommendations and make sure you understand the consequences of the options that they recommend and you choose. Ask questions like, what happens to the value of my investment if the market falls, rises, or stays the same? And when can I get my money back if needed for an emergency? Also, can I get my money if needed without big losses? Will this investment guarantee me a lifetime of income? What are the tax consequences and any other questions that concern you? Do not just take everything at face value. Know what you're investing in and make double sure you understand it. So the second big mistake most retirees make that cause them to outlive their money is taking unsuitable risk. If you can't afford losses, then don't gamble with your retirement money. Those retirees that were burnt in the market or that realized from the outset that the market was too risky for them are prone to make an equally serious mistake, putting all their money in super safe bank deposits. Granted, you've eliminated the risk of loss, but have taken on another type of risk, the risk of earning less than the market will return. We all know that a dollar lost is a dollar not available for retirement. And if the dollar is not earned due to below market earnings, it too is lost and not available for retirement. Those that choose the 100% bank option now find themselves locked into the lowest interest rate in a generation. Low bank rates may have forced you to dip into your principal. You don't have a lot of good options now. If you go back into the market in hopes of getting higher returns, you assume risk and possible losses. If you select longer-term CDs, you possibly lock in very low rates for years to come. If you stay where you are, you'll worry that inflation will erode your purchasing power. On the other hand, if you were an experienced money manager, you would investigate laddering your money in different maturities so it would come due when needy. Laddering your money assures you'll earn the average over time, over the cycle, rather than guessing when to go long, when to stay short, or when to go in or out of the market. So the third mistake many retirees make that causes them to run out of money is keeping all their money super safe in short-term bank deposits as if all the money will be needed tomorrow. Most retirees and also brokers working for Wall Street firms measure retirement money by how tall it is rather than how long it will last. Now, since the greatest fear is running out of money, doesn't it make sense to think in terms of how long rather than how tall? Wall Street always touts how tall because they can't guarantee how long. Yes, they have models that predict how long your money might last, but there are no guarantees because the market is not predictable. The insurance industry, on the other hand, has developed policies that do guarantee you a lifetime of income. They're called fixed annuities, and they're backed by the full faith and credit of some of the world's oldest, strongest, and most trusted insurance companies. The same companies that insure your home, your car, your boat, health, life, business, and virtually every other asset you have. But when it comes to retirement money, the typical retiree doesn't even consider the insurance company and the guaranteed lifetime income. So the fourth reason why retirees run out of money is because they do not consider all the options, even the safe ones like fixed annuities. Another area that needs your attention is taxes. Retirees have a tendency to pay too much because they don't plan. For example, let's say you have a $250,000 in a bank CD and it is earmarked to be used during late retirement. And let's also assume the CD is earning you 5%. Annually, you're earning $12,500 in taxable income that you don't need until late in retirement. The $12,500 comes because you earn 5% annually on $250,000 in a CD. If you're in the 25% tax bracket, you're paying $3,125 in taxes. What if you invested this money in a tax-deferred place? Tax-deferred means you'd pay no taxes on the earnings until you actually withdraw it. So the $3,125 annually that you're now paying in taxes would continue to earn interest rather than going to the IRS. And over the years, that would add up to a lot of money. Also, the extra income from the CD you're earning will boost the taxes you pay on your Social Security benefits. If income taxes rise, as I'm confident they will, tax deferral could give you a big advantage. Your financial advisor can show you several suitable tax-deferred options so you can get triple compounding on your retirement money. Interest on your principal, interest on your interest, and interest on the money now being paid to the IRS. The fifth reason retirees run out of money is because they pay the IRS money that they could have used for retirement. We could go on, but unfortunately we've run out of time. So what's your solution? It's simple. You need to become a financial expert or find one to work with. I know you don't trust anyone and you think you can do it better. But please know there are many hardworking, honest financial advisors that make their living helping retirees prepare for a better retirement. If you elect to continue to be your own money manager, then learn as much as you can and make sure you righteously safeguard your retirement money, because I suspect these next few years are going to present some serious challenges as the economy, markets, banks, and retirees adjust to the irresponsible policies of our national elected representatives in Washington. Thanks for your time, and please have a wonderful day and an even better tomorrow.